Good morning and welcome. I'm Jonathan Schein with Institutional Real Estate Inc. And on behalf of our presenter today, Barings, welcome to today's webinar, Real Estate Fact Finding and Fortune Telling in the COVID Era. And I may say good morning, good evening, and good afternoon for our global audience. I'd like to present our powerful panel this morning, which includes Danita Johnson, Principal Investment Officer, Real Assets, Connecticut Retirement Plans and Trust Funds, Allison Yager, Partner, Global Head of Real Estate, Mercer, Joe Gorin, Head of Portfolio Management and Value Add Investing, Barings Real Estate, and Allison Yager, Head of Real Estate Debt Portfolio Management, Barings Real Estate. Welcome, everybody, and thank you. We have a great hour ahead of us, and I'd like to just jump right in. So, Allison, starting with you, as a consultant to many pension funds, have you changed your attraction to core plus, value add as an account of the pandemic? And have you shifted your strategies or pricing expectations or other, what have you?
Thanks, Jonathan. That's a great question. So Mercer believes in real estate as an asset class for our clients for the long term. So in regards to having an exposure to real estate, we definitely did not change our view of that. We believe in the diversification benefits and the strong income component that that supports investments in real estate. We did, however, make some adjustments, particularly at the beginning of this whole pandemic and the valuation concerns that we had last year after first quarter and even into second quarter, and slowed down on allocations to core and core plus. Even though I'll tell you that core and core plus typically is the bedrock of most of our clients' investments in real estate, and then they'll add in value add and opportunistic to add some alpha potential to their real estate portfolio. And we also started looking, I would say, even more for contrarian views and whether there was going to be distress opportunities that would materialize.
Well, let me ask you, in terms of slowing down that allocation, did you balance it between open-ended funds and closed-end, or was it just sort of across the board?
Yeah, so mostly it was the open-end funds with the valuation concerns. And it really was just a short-term situation related to when the timing of the slowdowns in the economy and the valuations, and then the concerns to make sure that all of the appropriate information had been included in the adjustments of the real estate, and also to make sure there was consistency. There was a little bit of inconsistency, unfortunately, across how some valuation measures were adapted in the open-end space. And so we wanted that to play out a bit and really understand what each manager was doing in that regard.
It's kind of an open-ended question right then and there. I'd also like to, I forgot to mention to our audience, if you have questions, there's a Q&A feature at the bottom of your screen. So if you have any questions along the way, please post them and we'll try to get to them. Now, Danita, as a state pension fund and listening to along the lines of what Allison was discussing, how are you looking at that question in terms of allocation, in terms of open-ended, closed-end funds? Are you also looking more opportunistic across the spectrum? Or how are you looking at core plus, and value add?
Thanks, Jonathan. So as Allison mentioned, core formed the bedrock of our portfolio. And because of the increase in valuations in the core space prior to the pandemic, and that there had not been new allocations to real estate for a number of years, our portfolio was heavily weighted towards core prior to the pandemic. And so we were looking to rebalance the portfolio in line with target. But given where we were in the cycle, we were being cautious. So we were focused on core plus, value add. We also trimmed the number of open and core funds that we had in the portfolio. And we're looking at defensive strategies of those that clearly, had long-term growth trends. But we were careful about investing in opportunistic strategies at the peak. Post-pandemic, we shifted a bit. We took a pause on some of those strategies, took a pause on open-end funds, student housing, senior housing, and medical office, and looked to take advantage of some dislocation in the credit markets. And that was a theme across our portfolio, including real estate and at sectors that were clear winners. So life sciences, logistics, data centers, and we continue to look at those strategies. And I think, as we see transaction volume pick up, we will start looking more at diversified opportunistic strategies because I think that there will be opportunities for distressed acquisitions across property types.
That's great. No, thank you for that. Excuse me. So why don't we bring Joe in to just kind of give a kind of a bird's eye view of what both Allison and Danita said, because obviously they're moving a little more into the opportunistic part of the spectrum, certainly at this time in the market. I'd love to hear some feedback on that.
Yeah, I mean, we're hunkered down and focused. I'm on the equity side and Nasir's on the debt side. So there's so much we need to figure out as to where the trends are. The pandemic is evolving and its impact on office and retail. I mean, office was shifting towards a more open plan layout. Now remote working is likely here to stay. We need to play that out. We need to see what happens. So pricing with regard to our existing portfolio, the valuations are, we have to focus on where we think the puck is going for a lot of these assets and focused on the right values at the right time. We're not going to figure this all out in the first 6 months of the pandemic. There's going to be some structural shifts across a lot of product types. So we're focused on really gathering all the data that we have in our portfolio, all the data that we have in our competitive set to figure out where pricing is, to figure out where trends are. So can we lean in to the opportunistic and value add spectrum at the right time? How are we creating value in our core portfolio? I don't think there's a time right now that says we need to be jumping, all in on any strategy right now. We need to really understand the fundamentals on the ground and where appropriate pricing is. Where we have more transparency clearly is in the multifamily and industrial sector. That's the stuff that's financeable right now. And from an equity perspective, I can get my arms around where values are, both in my existing portfolio and where I want to invest. And that's going to be more on the core to core plus side, where I see that, the opportunity in the future, and we are seeing some interesting opportunities now, is really on the office, retail, and hotel side. But you've got to be patient. That's where you're going to have more structural impact. Less structural impact probably on hotels. We know what a hotel is going to be coming out of the pandemic. We know how people are going to use those, but people have been learning for a while how office is going to be used and how retail is going to be used. So it's kind of a long-winded answer to say that, I think there will be opportunities in core plus value add coming out of the pandemic, but right now we need to be patient and cautious.
Patient money. Well, thank you for that, Joe. So Nasir, Danita touched upon credit strategies, and I know that you work with the debt side of Barings. So I'd like to ask you a couple of questions. Is it a canary in a coal mine, or is it an opportunity, or a little of both? Because there's lots of different kinds of debt. And how do you present that kind of strategy to, say, an Allison or to a Danita?
Yeah, I think you're absolutely right. There are different risk profiles across the debt spectrum, and then we invest across that debt spectrum, whether it's core plus, value add, or opportunistic in construction. And I think each of those categories has some merit in today's market, but there clearly are risks, and that risks aren't just necessarily at the asset level. I think one of the fundamental things you have to look at is the borrower, and not all borrowers are created equal, obviously based on balance sheet, but it's also based on performance. And so I think when we think about the way we want to lend, you can't structure around bad real estate, right? You can only depend on your basis, the borrower, and the building and the property type itself. So as long as you're sticking to those fundamentals, you can find value in each one of those categories. The liquid markets, though, have really driven the return profiles for those categories in divergent ways. When you look at that core space, because it's mostly dominated by banks and life companies, which are using corporates as proxies, those yields are coming down a lot faster than you're seeing in the more private-driven sectors like core plus, value add, and opportunistic. I think it's a really scary time to be a construction lender unless you have the ability to take equity back and manage and own an asset. I don't really understand how banks or other lenders would want to dive into that space, given the uncertainties around what we're seeing. A lot of the positivity in the market today is driven by this vaccine, but there are still some logistical challenges of the dissemination of the vaccine. And I think we're all assuming that there's going to be mass adoption of the vaccine. We don't know what percentage of the population is going to opt out of vaccinations. And we haven't lived, I certainly haven't lived through a pandemic, and none of us have. So we think we know what's going to happen once everybody gets vaccinated, but that's if everybody gets vaccinated. So there's still a lot of uncertainty with all of that. Hopefully I'm providing some clarity in terms of, I think debt is certainly a safer haven, but there are still lots of fundamental things that you have to make sure that you're accounting for when you're making those decisions. Where we see the most relative value is probably in that core plus space, maybe into some of that value add. Because I think the risk that you're trying to take in the opportunistic space in debt is still too uncertain. And then if you go into the core space, you're competing with the market that's just being turbocharged by fiscal and monetary policy.
Oh, thank you for that. And you do, oh yeah, Allison, were you going to say something?
Yeah, I was going to jump in if you don't mind, Jonathan, and ask you a question. We have conversations with, lender contacts that we have, et cetera. And for the most part, we're not hearing about a lot of foreclosures and takeovers from the lender perspective, but we are hearing about some distress and some, delinquency in payments. And we all know, I think all of us were old enough to have lived through the global financial crisis, that there was this kick the can down the road strategy. And I think, we feel like banks are definitely going to be worried about taking back a lot of real estate on their balance sheet. They don't want to do that. They know that was a disaster the past few times, whether it was the S&L crisis or anything else. Now I'm really aging myself, but that didn't work out too well. So what are you hearing in that regards? Are you seeing that there's a little bit more of that than we're actually all aware of, or is it just really around the margins or in these sectors that really do have the distress, the hospitality and those types of sectors?
Yeah, I think people thought that they could kick the can down the road because the vaccine was going to come and then everything was going to turn around and be better, right? Now, what's going to happen in 2021 is whatever can they kick down the road to this year is going to come to roost, particularly in hospitality and retail assets. So if you have large exposures to that, we have approximately just under 500 loans on our books. Of those, 6 are in special servicing, so just a little over 1%. Some of that could be luck, meaning that we had less in look. Of the 6, 5 are retail and hospitality, and 1's a condo and a gateway market. Okay, so of those 6, right, some of it's lucky, maybe it's better to be lucky than good. We had less exposure to hospitality and retail. And then it's also who you lend to and how you structure your loans. I think when you look at a lot of the transitional lending that was done, you're probably able to kick that can down the road in 2020 because you had reserves and other things built into your loans. That's going to be gone in 2021. So there will be an uptick in distressed debt in 2021. It will certainly be in retail and hospitality, but I think there are other asset classes that are at risk. That's office, it's residential and coastal markets. There are other things that are going to come to roost. I think it's going to be a problem for banks. I think it's going to be a problem for insurers. I think it's going to be a problem for debt funds and mortgage rates.
Yeah, if I could just add on our existing portfolio and some of the equity deals. I think you're going to see in 2021, there will be some more stress in the urban multifamily area. You'll be breaching some covenants there, and that's going to have to get dealt with. And to Nasir's point, how long can you kick the can? How long are these lenders going to continue to amend? And office, in our office portfolio right now, 60% of the tenants who are rolling in the next 6 to 12 months can't tell us what they're going to do. And so there's a big what if, I think, in those two categories as well. Hospitality, I think this year we've seen deals together on the hospitality side. Those were the first ones to show up. But I think that, again, this gets to the point of you're going to have to wait it out a little bit to see what happens here.
And then, obviously a lot of the waiting out, it does have to, as Nasir said, has to do with the vaccine. And I'm not going to press anybody, but I bet that less than 50% of the people on this particular webinar have gotten their vaccine shot yet. It's just a guess. You know, and that kind of translates to the industry and to the community, the world as a whole. Now we're talking about property-specific types of things, and we did get a question from the audience regarding standalone retail buildings going dark. Are we at a mall apocalypse? At one point, these were considered very stable investments. Are you finding that a lot of stress in your particular portfolios, Danita? Are you in that? Allison, are you familiar with that strategy, and have you put some of your organizations into those?
So I'd say that we benefited a lot from what we did not do. And so we didn't have a lot of mall exposure in our portfolio. And prior to the pandemic, as we were trimming down the number of core funds that we had in the portfolio, we did look at, you know, certain asset tabs and exposure there. And those were the funds that we put in redemption requests for. I would say in regards to retail, the retail that we do have in the portfolio is grocery anchored, convenience oriented retail, and it has performed relatively well. And so I think I still think that that's a segment of the retail market that I would not be against looking at additional investments there.
Okay, Allison?
Yeah, and so we have had retail, including malls, in clients' portfolios over the years, but this retail phenomenon didn't start with just the pandemic. So this started a while ago, and we've been decreasing the mall exposure, not getting out of it completely. And maybe because I have a teenager who's a female, there will always be a need for malls, I believe. I like going to the mall.
So you're speaking for yourself.
Yeah. But it's, you know, we were definitely over retailed in this country for sure. So too much retail, and especially in the apparel space for sure. So we had recognized that a few years ago and had been reducing our clients' exposure to that type of retail, and agree with Danita, the grocery anchored, you know, is something that has been in the portfolios. Had a great year last year, of course, with everybody focused on stocking up their entire extra room or basements with food in case of shortages. So that helped, which that might normalize a little bit this year. And also we've expanded our clients into other sectors, as Danita mentioned, you know, starting a couple years ago, into sort of what we call slightly non-traditional sectors that are a little less GDP dependent. So life science and senior housing and student housing, data centers, those type of sectors.
Yeah, we want to
Just on,
yeah, Joe.
Well, if I could just add on retail, and we're predominantly in grocery anchored centers, especially in our core plus investing. We're not doing any retail and value add or opportunistic right now. But I think if folks are looking at the future, I mean, again, to Allison's point, you know, retail vacancies over the past year are just up 70 basis points. So that number doesn't jive with the fear factor around retail right now because of what's been happening. You know, e-commerce was a huge impact on bricks and mortar retail way before the pandemic. I would be very concerned with a lot of these standalone retail projects, and what we're focused on is what's the chemistry of a project that can allow it to meet where we believe retail is going, which is fulfillment of online orders. It's so much more expensive for a retailer to ship your product to your house. They'd much prefer you buy it online and show up. So those areas, those centers that can accommodate both in-store shopping and fulfillment of online orders, because they've got the right parking ratios, they've got the great access, they've got the right sizing and distribution, physical distribution elements. Those are going to be interesting. I think there's going to be a real demand for that type of project. You just have to figure out what do those retailers look for. There's a shifting obsolescence and functionality here that could provide opportunity.
Well, I was going to say, does it create
And risk.
opportunity with some of these standalone issues at this point? Yeah.
For the right locations, I think it does. There are groups that have been formed to take advantage of this, and but you have to be an expert. You got to really understand what you're getting into, and there's going to be more obsolescence than functionality, for sure.
Yeah. So one of the things, yeah, Allison.
Sorry, I was going to say in regards to Joe's comment, I think there is definitely an opportunity to recapitalize and reinvent some of these centers, but I think the verdict's still out as to what that is. I know we talked a lot about, oh, they could be distribution centers and everything's going online. I don't think everything's going online. And I also think that one thing that's missing in that conversation is I don't think these neighborhoods where these centers are located are going to be so thrilled about having vans and trucks coming in and out all hours of the night. So, you know, one, they're obviously zoned retail, they're not zoned for warehouse and industrial. So you have that alone, and that's just city councils or township councils and those types of things that maybe you can get through, but you also have all the people who live around it. And so, and you don't want to be where those end up just in the areas where the people aren't, you know, organized enough to fight it, and you know, maybe higher income areas will fight it, so then they go to other areas, which wouldn't be a good outcome for, for the cities.
Transforming malls in some of this retail into real distribution where you have trucks coming through neighborhoods, I wouldn't go after that. Where you can bring the end consumer into the project to pick up packages, distribute, that's where I think it gets interesting. But again, more obsolescence than functionality here. I agree with you.
Yeah, never underestimate the power of NIMBY. That's for sure. Yeah,
I was just gonna say the alternative use value is a lot less than what that original valuation was too. So as a lender, I'm always worried about preservation of capital. So as much as you can take a defunct mall and turn it into a distribution center, doesn't necessarily preserve all the dollars that I had out lending on a mall like that. So certainly kind of a different perspective there.
It's not quite as easy as the play that was about maybe 8 years ago, where the timber managers all of a sudden were buying timber not for the timber on the land, but for the land use. So unfortunately, this one's going to be a little more difficult to figure out, I think, than that.
Why don't we kind of go into that? Oh, yes, Danita, sorry.
I was just going to say one of the things that we've been watching is, you know, prior to the pandemic, there was a lot of talk about transforming more malls to these destination centers with movie theaters and all types of entertainment. And so it'll be interesting to see as, you know, the next phase of the pandemic, or as we come out of this, you know, if people will return to the malls and what's the impact on behaviors of the long-term impact on behaviors of the pandemic.
Sure. And that kind of leads into the question, and Siri brought up valuations. How are we getting comfortable with valuations? Are they real? Do they exist? I mean, Danita, what do you ask from your managers in terms of valuations? Are you getting the transparency you're looking for? Allison, I'm sure you have the same concerns. There's been no transactions, certainly not as many transactions.
Yeah.
So how do you gauge valuation?
So because we have this portfolio that spans across risk return strategies, it's been interesting to watch the movement or lack of, in some cases, and valuations across the portfolio. So most of the movement that we've seen is in the core plus and value add space, where some of those managers were proactive in taking write downs and adjusting for future rent levels, as well as extending out their business plans. And as Allison mentioned earlier, in the first and second quarter, we were concerned because there was less movement in the core portfolio, but understanding that there were no transactions and that these are more stabilized portfolios. But we've started to see the adjustments being made on our core portfolio. And I think it's been consistent across managers.
Allison?
Yeah, I would agree with Danita. The first couple of quarters, I think, hit everybody by surprise a bit, but we were pleasantly surprised at the analysis that was being done by, you know, some of the core managers that we work with in regards to finding out information about tenants. And I know sometimes it's not written in the lease that you can get financials and all sorts of information, but they were really reaching out tenant by tenant to try to figure out whether they thought there was validity for, you know, for that next cash payment that was due. And that's what we've been asking our managers to focus on, just, you know, the income preservation, or how are you creating income if that's your strategy, just to really understand, because there's always uncertainty in values, right? They're based on forecasts. So that's been around forever. This makes it a little more heightened, obviously, because there's uncertainty in lease terms, as Joe mentioned in their conversations with tenants, credit concerns, not to mention what will the next rental rate renewals be at, what level will those be at. So happy that we've seen, especially in the core and core plus space where you are adjusting values every quarter, a lot of just hyper focus on what's going on with each individual tenant, and then trying to make sure that that's addressed however it needs to be in the appraisals.
Well, you bring up a good point. I'd like to bring this up with Joe and Nasir in terms of credit worthiness. It was always kind of easier to see a retail tenant and see what their credit worthiness is, or hospitality. How are you looking at office tenancy now, and how are you gauging their credit worthiness? Are you looking at that? Is that something in the future that you're going to certainly concentrate more on now?
Yeah, I would say we're always focused on credit with our office tenants, whether it's before, during, or after the pandemic. I think on valuation, office is one of the areas that we've all kind of focused on where we think rents are today. We're not really sure because there's so many kick the can leases going on for 6 to 12 months, where landlords are agreeing to just keep the rent at the current rate for the next 6 to 12 months. We're upping our TIs and our free rent, but and that has the impact to value. So what I don't think a lot of the managers have done yet, because we all believe in the capital market staying strong after the pandemic, is we haven't made big changes. I would argue maybe we've been a little bit more, I don't want to say draconian, but versus the average Odyssey manager, we have taken our office values down a little bit more than average. But across the board, I don't think there's been a big shift in thinking that interest rates will move for office. And so cap rates are still relatively tight. When you're looking at your valuation, it's most impacted by income. But we're still focused on the same cap rates we kind of had before the pandemic. I think a lot of the managers are looking at it that way. So that's the big question mark as to the risk profile, and that gets into the credit quality of the income stream. I do think that, and it's why when we look at office, I'm not just focused on credit. And if we're talking specifically about office, we've got to be focused on the use and where the growing sectors are, and maybe even taking some credit risk on growth technology. Look at life science. There's a tremendous amount of money that's being raised for life science. Those tenants have no credit. But yet capital is super excited about the demand wave that is hitting life science. So I think when you talk about credit quality, you have to marry that with demand growth. And sometimes you're going to have to take some exposure on the credit because you believe in the growth. And we believe in life science growth. We're actually doing an office to life science conversion. We're kind of trailblazing in downtown San Diego. We know the demand's growing there. And I'm willing to take some credit risk for that specialized product. I'd almost want that more than taking higher credit and shorter lease duration in kind of more commodity product. So it's a really important time to focus on the specialization of use and how people are using assets, and also marry that with the ability to grow their credit quality over time.
Well, I believe, if I'm not mistaken, with life sciences, so many of the tenants that don't have credit are getting funded by the NIH, and so they get that ticket and they enter the space. Nasir, did you have something that you wanted to add to that?
Yeah, I mean, I would say that, look, it's there are only so many Amazon fully leased distribution centers that we're going to lend against, right? So at the end of the day, I want to echo a lot of what Joe said. You're looking for secular trends, you're looking for resilient spaces, you're looking for the right economic trends and market fundamentals, and that's backed by things like science, medicine, education, technology. If you have those factors kind of supporting your tenant base, then it certainly works. And as we would lend against a life science project that could be leased to obviously a lot of non-credit tenants, we have to be cautious about how much exposure we want to take in that space as a lender, because there are things about that remind me about the dot-com bubble, where every person with an idea was getting thrown money at because they were going to create the next tech revolution. They were going to create the next Amazon or Google or whatever it was. So I do think we want to be careful about that. But again, all those trends, when you're looking at those areas, I think that the one that I probably missed is probably entertainment. So a lot of that content driven use of space from the Netflixes and Amazons of the world. Markets like that are interesting to us as a lender, and I'm sure they're interesting to Joe as an equity investor.
Well, that kind of dovetails with a question that came from our audience. So I'd like to go to Allison and to Danita on this. Have your views towards sector-specific funds versus diversified funds evolved as a result of the pandemic? In other words, you've discussed niche strategies and opportunistic and alternatives within our alternative industry. So I'm just wondering, are you looking at different things, or are you still looking to kind of play the safety net with diversified?
Yeah, that's a good question. I'll go first, Danita, if you don't mind, and then you can jump in. That is definitely something that has evolved actually over the years. I would say, years ago when I first started at Mercer and when I worked in the industry, it was all about diversified funds. And we've seen more growth in sector funds, but sort of limited to industrial and multifamily. But then recently, obviously, we've seen some growth with funds that invest in some of these, what I call the non-traditional sectors. And we, as I mentioned before, we had been diversifying portfolios into those sectors because the traditional diversified funds were sort of embedded in the four traditional property types: office, industrial, retail, and multifamily. And so they just weren't quite ready or able in some cases to really be able to expand their sector focus into these other areas. So we've been adding those other types of funds to clients' portfolios. And then even more recently, and we had some of the focus, on the industrial area for industrial only funds, but continuing to add even just a one sector fund, even in the core and core plus space, which I would say, being I grew up in working for a core fund years ago. And so a little bit from a conservative area, we wouldn't necessarily have added a one sector fund to a core portfolio, but I think that is something that been doing because we find that some of these are really specialized and you want a manager that has that type of expertise. And it doesn't always mean that it's an opportunistic type strategy. It might be something that you want to own for the long term and you want to have exposure to this. So that's the best way to do it.
Oh, great. Thank you, Danita.
I think there's room for both in our portfolio. I mean, there are specific sectors that we've identified as growth sectors and that have strong demographic trends supporting demand in those sectors. But there's the benefit of some of the more diversified funds is that they can move more quickly than we can, and they can identify opportunities before we see them evolving and then take advantage of them. And so, as I mentioned before, for distress and for other opportunities that are evolving as the market evolves, we would rely on a more diversified fund to take advantage of those opportunities.
Oh, thank you. And now this kind of brings us into another part of the webinar. I mean, what are the biggest challenges to your current portfolios and allocations? How are you dealing with those? I guess I'll start with Joe. Where are you finding stress, the pain points?
Well, in terms of our existing assets, I think we kind of hit early on that the pain points during the pandemic are, we do own some hospitality more in our separate account format. And so obviously there's some pain points there for sure. And urban multifamily. So, just dealing with the pricing and how competitive do we have to be with concessions to make sure that we're making it through the pandemic to the other side. We like where we are and we've been very careful on where we're investing. So there's obvious pain points in terms of existing assets. And I would say, I hit on, if you have commodity office, there's so much uncertainty that making sure that you're engaged with your tenants and you're understanding, what they want in terms of health and wellness and how they want to program their space in the future. Those are just existing pain points. And I think everybody kind of knows a lot of that. In terms of raising capital right now and going out and investing into new product, I think that there are pain points across that spectrum. And this kind of gets into a little of the canary in the coal mine where, cap rates are still really tight for that area of industrial and multifamily. And, you've had more supply come into industrial than you've had absorption over the past couple of years, and that's anticipated to continue for another year, albeit industrial is very strong and we all believe in the tailwinds that exist. But the challenge that we have, and it concerns me a little bit less, we're just not going to say yes to get money out. And so, I think part of the pain point is saying no. There are groups out there with dry capital, dry powder, who need to get it out. And just to kind of pile on to the last question a little bit, the one thing that concerns me about some of the niche sector specific funds is we have expertise across a wide category. We work without operating partners and with operating partners, but some of these niche sectors that are raising the money right now feel compelled to go out and buy. And there are some challenges in some of these areas where I want to make sure that I'm at a discount to replacement cost. I want to go back to the fundamentals of real estate investing. And I'm seeing a lot of deals that I kind of scratch my head at in terms of the cap rate that's pushing the basis up to a level that gets me concerned. We really like single family rental space. But I'm starting to see pricing there that's concerning me, especially lumber. Lumber pricing is through the roof over the past month. So what's your basis? So there's a lot to consider right now. And I keep coming back to kind of how we started this conversation. Deliberate patience and discipline is really important right now. I'm super bullish on being able to invest accretively in real estate over the next few years. But the pain point right now are the operating fundamentals across a wide spectrum of real estate. And if the operating fundamentals are stronger, then the capital is more aggressive and the cap rates are tighter. And you just got to make sure that your basis is appropriate.
Thank you. And Danita, and I apologize, I live in New York, you may hear some honking out there, a lot of snow on the ground. Danita, are you finding the pressures to put the capital out to work for you right now? How are you balancing this? And Allison, for your clients as well, especially pension funds that need those returns.
Yeah, I would say that's one of our biggest pain points. We don't have a lot of issues or problem children in the portfolio, but our biggest challenge is that we have a target return. And recently we adjusted our allocation so that we could, be in a better position to reach that target return. And that included an increase in allocation to private markets. And so we are under allocated to private markets, across private equity, private credit, real assets. And so the challenge, and then as you know, there's a 3-year, typically a 3 to 4 year investment period, and you want managers to be patient and not to put pressure on them to invest. But we also have asset allocation meetings where we're constantly being looked at and say, why is private markets still under allocated? And even though we've made commitments in this space, so it is a challenge there.
Yeah, thank you for that, and Allison.
Yeah, we try to really do our due diligence on managers to make sure they're not going to, have capital be burning a hole in their pocket, so to speak. But it's difficult, and the transaction market has slowed tremendously, and the deals that are out there are still fully priced in most cases, especially in some of the sectors we've been talking about that are of interest to a lot of people. We luckily, to the original question, we didn't have a lot of pain in our portfolio. We had actually invested in a hospitality fund with a hospitality expert manager that it took us probably 3 years of due diligence before we moved forward with that, and we're perfectly fine with it. These were closed-end strategies, and some of it was development, which was actually fine. So they're just continuing to build, throughout this period. They wouldn't have been occupied anyway. And because of the focus that this manager has, and what we saw about the way they handled operating costs and everything else around investing and owning hospitality assets, we feel like that will be fine. And we probably will provide more capital to them at some point to take advantage of distress, because they're not in a distress situation, and they'll be able to help us help us find that stress in that area. But yeah, it's difficult that, like Joe said, and the cap rates in some of the sectors does kind of give you pause. And I think there's the other thing that doesn't get talked about a lot is, we have a whole change in the administration, and not to go into the political ways, because the political conversation, because I don't think we necessarily know what's going to happen, but there could be changes. And, based on all of the information we already know, some of those changes look like they'll be good for real estate, and some of them could be bad for real estate. So that, along with coming out of the pandemic and what does that mean for occupancy and everything else, are things that, again, back to valuation, cause that continued uncertainty about how these forecasts are really going to play out over the next couple of years.
Well, thank you for that. And I'd like to kind of circle back to what this webinar is about, post COVID-19, after the pandemic. Let's just kind of focus on one aspect of that. I think we can use that sort of as how the rest of the world. Let's look at office. Let's look at office itself. I mean, you've got urban office, you've got suburban office. I mean, I live in New York. It looks like we're all working from our homes today. How is that going to translate? Everybody wants to get back to the office. Everybody's going to say, I've heard the same thing. It's going to be a hybrid. But how does that create value? How does it retain value for offices? Now, Sierra, I'd like to actually hear from you on this, because obviously you have on the debt side. How is that portfolio playing out when you're in New York and maybe there's a 5 or 10% occupancy rate at this point? Whether they're paying rent or not, it's going to change.
Yeah, I think, look, from our perspective, one of the things that we're focusing on in our existing portfolio is actually has very limited exposure to New York City, which is fortunate for us. But what I would say is, we're looking at supply and then shadow supply, right? And so it's all the subleasing space that's going on, not to mention the co-working space and what's going to happen with all of that. And I think those are the things that are driving a lot of the uncertainty that we're seeing today. I've actually been using this storm recently to as an analogy for COVID and for post-COVID, which is, trying to walk through the snowdrifts of the storm felt a lot like last year, which is you're going through the motions, you're exerting a lot of effort, but you aren't getting very far, right? Mm-hmm. And now that the storm is over, some of the streets and roadways are shoveled or plowed and there's salt, but you can take a wrong turn and get stuck, or you could slip and fall. And so it's not like we're out of the woods just yet. And I think that that's more so true for office than it is for any other asset class out there today. So when we think about deploying money as a lender to office, sure, again, it's easy if you've got a long-term lease to an investment grade tenant that's on solid footing that goes well beyond your loan duration, that's fine. That's an easy analysis. What's uncertain is the multi-tenant building in a market that's challenged fundamentally by economic and demographic trends, as well as that shadow supply. So those are the things that we're keeping an eye out for.
Okay, no, thank you. And obviously, co-working, I think it's an oxymoron now at this point. I mean, Hotel just got filed for bankruptcy and getting acquired. WeWork's is filing for a SPAC. So we don't know what that's going to look like. But will people return to the office, and how will they will return to the offices? How is it going to look? Which brings up another issue in terms, and I'd like to kind of address this because it is an overriding issue, with ESG. How is that going? How is the pandemic going? Is that going to accelerate, or is it going to change the direction of how ESG is going? Allison, I imagine as a consultant, you focus on this quite a bit.
Yes, absolutely. And I think one of the positives out of the pandemic, if you can say there's a positive, is that the ESG focus has expanded to be beyond E. I think in real estate, we were really focused just on environmental. And now I know, at least for our questionnaires, there's much more. We obviously focused a little on governance as much as you can in real estate, but focus more on the social aspect and really, which is interesting that we hadn't done that in the past, because we always ask, as any manager knows, about the culture and what types of decisions were being made, because you have to you need to really understand what integrity you have within these types of firms. So I think just that social aspect kind of helps you to have a better understanding of culture and the individuals that are working there.
Right. Joe, you had something you wanted to add as well. Thank you.
Well, yeah, I mean, this, look, ESG was important during the pandemic. It's only more important. It crosses so many different lines. And, the E has always been the easiest part. The most challenging has been to solve the S and the G. And to us, that has to go, it has to be the vernacular of the organization. Because it's harder to fulfill the S and G. So you got to be thinking about it. You got to be talking about it. You got to be creative and innovative on the S and the G. So, I think it's, office, as we talk about, where's office going? It's probably the one product type that, it's easier to solve the E. And we've been doing that. I mean, our fund was the number 2 in the GRESB survey, which gets to, or GRESB index, which really highlights the importance of being able to report it. A lot of us are doing it. Some of us are doing it. We don't even realize it. But you got to report it. You got to send to your investors. This is exactly how many kilowatts I'm saving per day, per hour, per day, per week, per month, per year. But also reporting, how on the social, how are you staffing and how are you, focused at the organizational level, but also at the asset level. To really foster a better environment for us, for our investors, for our tenants and our clients. So it's a huge effort. I know we're all, I can't say, all managers are at some level are focused on it. I think the pandemic only magnifies it even more. And just to go back to the office, I think, because I've been doing this for about 25 years and grew up, in the Sam Zell world, the VOP and office. And I think this is going to be the most interesting period of my life in office, and I'm excited about it. But I'm also very cautious.
Sure.
I believe, and actually 2 of the most recent deals we're doing in office are around innovation and STEM, and as I said, life science. But we're also developing a building in Raleigh, North Carolina, right now that's 50% pre-leased in the middle of the pandemic, and it's got tech tenants. It's the fastest growing tech market, and it's a brand new asset that is special. I only want to own stuff that's special. I want to invest in stuff that the HR department says I need to be here because I can attract an innovative, skilled workforce. And it's the right location too. That's where the innovative class wants to be. They're growing in this market. Employers are coming in. Anything short of that in terms of office, I would probably just say, let me wait and see what happens there, because there's going to be a whole restructuring of a lot of these buildings and how they're used in the future.
Thank you for that. Now, when we talk about ESG, obviously,
Jonathan.
Yes, Danita, I'd love to hear from you.
I just wanted to add on to what Joe said in terms of ESG, because we have incorporated it into our due diligence process. And we found, as Joe mentioned, that a lot of managers are doing it. They're taking environmental assessments. They are incorporating, climate change and the impact of, tsunamis or hurricanes or fires on potential impact on their portfolio. And so we've been, focused on just engaging with managers and as part of our due diligence process, because a lot of times there's just a misunderstanding of what ESG is.
No, thank you. Well, actually, the S is getting to be prominent as well in terms of DEI, diversity, equity, and inclusion. And Allison and Danita, are you incorporating that into part of your criteria as well? And Barings, people from Barings, how are you handling that? So first of all, Danita and Allison, I'd love to hear from you on this particular topic and the ESG aspect.
Yes, we have incorporated due diligence as part of our ESG and diversity as part of our due diligence process for a number of years. And similar to ESG, our approach is engagement. It's understanding recruitment, understanding retention efforts, and then having a conversation with managers on, if they're not where they feel they need to be, then how do you get there?
Yeah, it's not in 1-2 step. It does take time. It is an evolutionary process, and to hold someone accountable because they just, even if they're starting it, it is an evolution. Correct.
Yes.
Allison.
Yeah, it's something that we've asked about and talked about for a number of years. I think our industry still has a long way to go.
Mm-hmm.
but we're tracking all that information. So it's, it's one thing to talk about it and say that you're recruiting and you're trying to do this and, oh, you tried, but you couldn't do this for some reason. But when you look at hard facts and, okay, you have to answer this questionnaire and here's what you had last year and here's what you had the year before and the year before that. And that is, hopefully that will help continue to move it along.
Joe, Nasir, I'd love to hear from the manager perspective. I mean, obviously DEI is important. I mean, it's more than important, it's needed and necessary. So, it also crosses whether it's debt or equity, by the way. So any
No,
comments?
absolutely. Yeah, no, absolutely. I mean, obviously just there's ESG at the asset level, but there's ESG that we need to implement ourselves. And the S part of that, diversity, equity, inclusion, is something that we're spending a lot of time on. I think that resources were always available. The training necessarily wasn't. And I think that there's more focus on the training. And I think that's important for everybody within any institution anywhere. So I think that that's one of the things that we just have to acknowledge where our weaknesses are and work on strengthening and improving them. And I think institutionally, we've spent a lot of time doing that. I think the pandemic drove a lot of that too, just in terms of that human outreach that was needed within the company and institutional environment. I think everybody's needs were very different because there were personal needs, economic needs, work needs, et cetera, that needed to be balanced. And but just speaking from my own experience within working at Barings, they did a commendable job, but that goes, again, there's still work to be done. And the fact that we're implementing training and other steps for DEI is really important to me personally, and I think it's important to the institution. Joe, anything you want to add to that?
No, and I think just one more comment, we are, and I would implore the managers, it's a lot easier now when you're looking at new investments, new acquisitions and talking about ESG. We come up with a new plan as part of our acquisition strategy, just along with a lobby repositioning plan. What we have a whole section, and what are we going to do for ESG at the portfolio level and at this asset, and not to forget about your current portfolio. And that's really important to really drill into. It's easier to start in the beginning when you're buying an asset. It's a little bit harder. It has to be part of the vernacular of the entire organization in terms of the existing portfolio as well, and the organization, obviously.
Thanks. So
one thing I wanted to add, sorry, Jonathan, real quick, is diversity, inclusion, and everything is really important aspect of the social, but also, and everyone would be remiss if I didn't talk about fees, because every manager who's ever met with me knows I always ask them about fees. But we're asking those questions, and we love to hear, what are you doing with all those fees? Are you fees? Are there fees? Is your firm giving back in some way? Do you have programs? Like I know at Mercer, Marsh McLennan, we have volunteer programs and have a lot of activities that all sorts of employees get involved with throughout the year. That's a big aspect to us of it too.
Giving back, and so the social responsibility aspect, yeah. So I'm sure that you have a program. We don't need to go into that right now, but I'm sure that you already have something going. As we're starting to wind down a little, I'd love to ask this question because we're looking into the future. We've had quite a detritus from the last year, pretty much. If we were to hold this panel a year or two from now, what will we say about 2021? Right? I'd like to start next year. What will we say about 2021 when we're in 2022? Isn't that a fun one?
I guess it's fun. I mean, it's I know what I hope that we're going to say, and I think I think all the indicators point to this is what's going to happen, which is we're going to have a tough first half of the year. Things are going to get a lot better in the second half of the year, and we're going to turn the corner. I think there's probably still one or two asset classes or sub-property types that will struggle past 2022 and beyond, and I think a lot of that's going to be driven by consumer behavior. And how that consumer behavior has actually shifted because of the pandemic permanently, as opposed to temporarily. But I think that in 2022, we'll just be saying, we're really glad this is all behind us. I'm happy to be on a plane. I don't mind if I'm stuck in the middle seat. I'm going to type away on my iPad or on my phone. So
you're looking forward to travel. I guess we're kind of still stuck in place for a little while longer. Danita, how are we going to look at 2021?
see it as a time of continued uncertainty, but also one where we will start to see opportunities pop up and possibly anomalies, things that we did not expect. But I think by 2022, that we'll start to see ourselves coming out of this and look back and as Nasir said, be happy to be coming out of it finally.
Allison?
Yeah, I would agree with what both Danita and Nasir said. And I think the other thing we'll look back on is in regards to the relationships that we have within the industry, you know, who shined in that area and who was transparent and who was honest. You know, where did we get the best information and you know, knew that we had picked the right partner to be invested.
And are you actually meeting, well, just as sorry, are you meeting new partners during this pandemic now that we've been kind of locked into our Zoom world? Are you more open to that? Danita, have you been more open to that as well?
Have. So there are a number of partners that I've met during, or potential partners that I've met for the first time during this year.
Okay, no, that's
Yeah,
important.
absolutely.
Joe?
You know, I think people summed it up pretty well. I mean, I think if I had to pick one word, it's the ultimate year of transition, right? This is when we're kind of we're connecting the worst to hopefully the recovery, and 2021, you know, is kind of when that happens. And I think we're hopeful that 2021 is the year for that, and 2022 is very much the glass half full and a big spike in demand across a lot of products. And there's a good setup for that, but I'm also cautious as to how this pandemic has only magnified a lot of trends that we were starting to see before the pandemic. So I think that this idea that, you know, real estate becomes much more critical for people in terms of how they use it and how they value it will only be proven through 2021 and beyond. And you know, in many ways, real estate's the end of commodity real estate is before 2021, and specialization is beyond 2021. As investors, I think, you know, that's how we have to look at it.
I'm going to keep it simple. I'm just looking forward to going to a restaurant where I'm not surrounded by plastic. So that's my hope for 2021, that they drop the plastic. So we are winding down, and I'm going to have a real quick question.
By the way, now I know when I travel with Nasir, he can take the middle seat. So you already offered that up on our business trip.
And this is just to Allison and Danita, just real quick. If you could invest in one strategy right now, just to finish it up on a real estate sense, what would it be? What would that one strategy be, Allison?
Yeah, it would probably be a contrarian strategy if I had to pick right now, something that I was going to invest in.
And contrarian to you is what?
It could be a sector, you know, that's out of focus,
Okay.
more than likely.
Okay, and Danita?
So it was a toss up between tech and healthcare related real estate, but I will go with healthcare related real estate. So life sciences and medical office.
All right. Well, look, I want to thank you for an incredible morning. Nasir, Joe, on behalf of Barings, thank you. Danita and Allison,
Thank you.
I want to thank you as well as joining us, and to our sponsor, Juniper Square. Thanks. And to our audience, thank you for hanging in there with us, and we look forward to seeing you soon. Take care.
Thank you.
Thanks, everyone.
Bye-bye.